the U.S. economy, is pretty resilient. But we shouldn't forget either that the U.S. economy is also slowing. What you're referring to is the latest data, in the housing market, which, yes, shows a clear patch of strength. But I would also argue that, if you look at the big picture, we continue to see a slowdown, and that's also what we forecast for, for the next year. There's quite specific factors that are driving the housing strength at the moment.
What do you think the smoking gun is? What is telling you that the U.S. economy is slowing substantially, and how worried should we be about that data?
Well, you actually can see the slowdown almost everywhere, with the exception of the labor market, and of course, the consumption that is associated with that labor market. So I would argue more than, watching the GDP numbers today, we should really watch the labor market. That has been really the main area of strength in the U.S. economy.
We had a fantastic panel yesterday. I don't know if you caught any of it or any of our recap, but in Sintra, Jerome Powell, the Fed chair, he talked about the longer term outlook for the Fed, saying he doesn't see core inflation coming down to 2% until after 2025. When do you see the ultimate pivot coming from the Fed and them actually cutting interest rates, taking into account what he said about core inflation?
Look, that's definitely been pushed out. So I think one of the biggest mistakes that, the market made, until recently, was to price in cuts fairly kind of soon, actually, late this year and early next year. And I think markets are coming, to terms with the idea that inflation is actually a persistent beast, and that central banks need to make sure that they, fight, that inflation hard. And that actually means that they may have to, keep rates, on hold at high levels for a long time. So I would argue, for at least for the next year, you should see, rates that are, high, at current levels or around current levels.
Are equity markets positioned for that scenario?
No, equity markets are positioned for late cycle, and typically in a late cycle environment, what you see is that, earnings continue to deliver, even though, they are, starting to slow in terms of growth rates. You continue to see volatility both in the rates market and in the equity market falling, and that sucks investors into the market. And there's, certain confidence about the fact that, central banks are fighting inflation. And admittedly, if you look at, some inflation indicators, it's not racing away, it's actually starting to turn. So this is actually classic late cycle pricing, where you see risky assets, powering ahead. But I would argue, an asset like equities, which is more growth sensitive, should be a little bit, less perky here. But we have to admit, in the US, for example, this has been largely a tech story. If you look at other, sub indices, it's been more range bound.
The Fed chair, Jerome Powell, has actually been pretty good at telegraphing to the market what they plan on doing. And I thought it was interesting in the panel yesterday, he was going over how they initially started with 75 basis points increments and then slowed down to 50. Now they're at 25, possibly skipping meetings, etc. So at this point, what do you think would constitute a surprise to the market out of the Fed?
Yeah, well, they were also very clear that, they are now data dependent. So I think a surprise will actually come hand in hand with a surprise in the data. So if we see, for example, inflation, increasing significantly, then the surprise will be, that they will have to do more before they pause. At the moment, the market is pricing in one more hike in July, and a lower probability of, something else in, or, perhaps a hike in September, but it's definitely not a done deal. So if we were to see inflation data a lot stronger, then, definitely the amount of hikes that the market is pricing would definitely change.